Hello, and welcome back to the Macro Gamer channel. My name is Mark Cassingham, and today we're going into our weekly numbers for week 34 as of today's date, March 15th, 2025. It's on Saturday. So let's go into our numbers. So our portfolio's net worth is at $454.46. This is as of March 15th, 2025. We have our portfolio weekly data for week number 34. This is going to be from March 10th, 2025 to March 15th, 2025. We have a net cash flow of $30, where you see this large spike up on the chart. That's a $30 deposit, so every 3 weeks, we deposit $30 into the account. We have a money-weighted rate of return of 0.39% for this week. We have a market gain of $6.10, and we have no dividend earned for week 34. So this is from March 10th to March 15th, week 34. Now we have the monthly data for week 34. There's a lot of volatility in this monthly data. You can see from February 20th, it's just basically been coming down. And then March 12th, after this $30 deposit, we've kind of had an uptrend happening right here. But this is from February 18th to March 15th. We have a net cash flow of $60.28. So that's 2 deposits, one on February 19th and one on March 12th. So $60 total, 2 $30 deposits, with the 28 cents being from extra cash or dividends. We have a money-weighted rate of return of minus 1.04%, so down 1.04% for the month. Again, as you can see, been very volatile a couple of weeks. The market has been taking a hit. All the tariff back and forth talk definitely has not been helping. We have a market loss of $7.28 over that month, and we have a dividend earned of 13 cents. So this is monthly data for week 34 from February 18th to March 15th. Man, I'm having a day right now. Now our quarterly data for week 34 is from December 16th to March 15th. We have a net cash flow of $153.52. So it's going to be 5 $30 deposits. We got 1, 2, 3, 4, 5. Every time we see this stair step pattern happening, that's cash deposit. The extra $3.52 is just from extra cash and dividends. So we have a money-weighted rate of return of 1.66%. So on the lower side, because as you can see, this first step, pretty flat. The second one came up a little bit. Third one came up a little bit, and this fourth one just came down. This is where we've been having all this volatility. So like middle of February to almost middle of March, we've been having a lot of volatility. We have a market gain of $5.31, and we have a dividend earned of 37 cents. And that is our quarterly data for week 34 from December 16th to March 15th. And we have our all-time data for week 34. This is from inception. So from July 21st, 2024, when we opened the account, when we were at $0 till today, March 15th, 2025. Right? We had our initial $100 deposit, and then we've had, I think, 11 now, $30 deposits. So you have net cash flow of $434.61. So if we count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11. So you have $330 of auto deposits, and our initial $100 deposit when we opened our account for $430. The extra $4.61 again from extra cash and dividends. So over this time period, we have a money-weighted rate of return of 8.51%. We have a market gain of $19.85. And we have dividends earned of $1.53 over that time period. So this is our all-time data. So we have our percentages. We have our weekly percentages for week 34. We have our target percentages over on the right. So gold we still have at 30% with our GLD ETF. Commodities we have at 20% with our USCI ETF. And a recent change we did here on Monday is we reduced our dollar position down from 20% to 15%. So now we're at 15% for US dollars with our UUP ETF. And then we took that 5% that was off of the dollar and we put it back into bonds. And now our GOVI ETF went from 10% to 15%, so it's increased. So we have that with our GOVI ETF, our bonds. Then we have our stocks at 15% with our ETF RSP. And we have Bitcoin at 5% with our IBIT ETF. So those are our new percentages as of this week. So 5% pulled out of US dollar and put that 5% into bonds, which, as you all know, if you followed along, I hate bonds. But I think we may be in a turnaround period. We'll see. At the very least with this volatility, bonds have been a little bit better. So we have our weekly numbers here. For gold, our GLD ETF is up 2.58% for a market gain of $3.41. Our commodities position with USCI is up 0.32% for a market gain of 28 cents. Our US dollar is down 0.04% for a market loss of 3 cents. Our bonds down 0.16% for a market loss of 10 cents. Remember, we don't have a whole lot of data with this new ETF, so I won't have like quarterly all data that's accurate. Let's keep that in mind. We have our stocks down 2.13% for a market loss of $1.42. We have Bitcoin down $1.82% for a market loss of 41 cents. So this is our portfolio weekly data for week number 34. Now we have our portfolio monthly data for week 34. We have our gold up 3.35% for a market gain of $4.30. We have our commodities down 1.57% for a market loss of $1.34. We have our US dollar down 2.73% for a market loss of $2.22, and the dollar's been losing a lot. That's the reason why I reduced my position. We have our bonds up 1.24% for a market gain of 61 cents. Keep in mind that we're not going to have a full thing for GOVI. That's fine though. We're going to get more over time. We have stocks down 4.62% for a market loss of $3.01. So this is reflecting a lot of market volatility right here. And we have Bitcoin down 12.09% for a market loss of $2.71. So Bitcoin's also taking a hit. That was week 34 for the month. Now we're doing quarterly percentages for week 34. So over 3 months. We have gold up 13.02% for a market gain of $14.12. We have commodities up 4.24% for a market gain of $2.78. US dollar down 6.41% for a market loss of $4.84. This is what I'm talking about. Dollar's been doing horrible. And then bonds are going to be the same because, again, I do not have a longer duration with this new ETF, so you're not going to see a whole lot of data. Stocks down 5.36% for a market loss of $3.07. Again, that's a lot right there. And Bitcoin down 17.38% for a market loss of $3.41. So stocks taking a hit, US dollar taking a hit, Bitcoin taking a hit. The 3 things that went up post-election are all coming back down hard now, which is kind of funny. Then we have our all-time data. We have gold since the beginning up 24.95% for a market gain of $18.06. We have commodities up 13.37% for a market gain of $5.31. US dollar down 5.74% for a market loss of $2.80. Again, GOVI, not enough data to have this. Stocks down 5.29% for a market gain, a loss of $1.92. The Bitcoin up 33.54% for a market gain of $3.49. So these are our numbers. By far, gold has had the best performance and pattern, which you always see on the charts that show every week. By far the best asset, and I've kept it at 30% this whole time. So, doing real good. Sorry. So we have this new position change we added on March 10th, 2025. As I said, I decreased my US dollar, my UUP ETF. I decreased it by 5%, and I moved that 5% over to bonds in the GOVI ETF, so plus 5%. So I added another line item here. So since the beginning, we opened the portfolio. These are all my position changes. So it's just a quick snapshot. You can see how I've moved money around over the several months. But the most recent one, March 10th, just this past week, reduced US dollar by 5%, increased bonds by 5%. Now, portfolio transactions. So on March 10th, this is the transaction for that change. So I had two sales. At the US dollar, I sold $20.99. This was me reducing that 5%. And I sold the extra, I had in gold because I did a rebalance. So I had some extra gold, $2.03. So I sold that. And then I bought primarily GOVI. I increased from 10% to 15%. And then with a little extra money, since Bitcoin was down, bought $2.48, and commodities were down, I bought $1.21. So $23.02 of a sale and $22.53 of a buy right here. So this was the 5% position change. And then on March 12th was another $30 deposit. Every 3 weeks, $30 gets deposited, and it gets distributed amongst each asset. So commodities, we bought $5.93. US dollar, we bought $4.47. Bonds, we bought $4.84. Gold, we bought $8.36. Bitcoin, we bought $1.26. And stocks, we bought $5.77. So that's how we distributed that $30 deposit. So these are the two transactions on March 10th and March 12th for the portfolio. Then we have Illuvium staking. So current price is at $14.48, coming down a whole lot for week 34. Our Illuvium staked, we have 9.44 ILV staked for a current market value of $136.66. We have our Illuvium vesting, so we have all of our vests here. In July of 2024 was our very first vest, and then August, September, October, November, December. It unlocks, you see the unlock period, so the closest one is going to be the first one we did in July. And then we have the second page, the most recent one we did for $2.30 ILV. That was staked on March 3rd. I had an issue with staking on the 25th around usually when I do it, but it's fine. I got it fixed, so we're good now. So this is our Illuvium staking and our vesting. So hopefully we get a revenue distribution payment soon, because we have not gotten one. We got our 3 first ones, which equal 0.024 ILV for a current market value of 34 cents. We will see if hopefully we get one in the near future. Obviously, a lot with crypto gaming has just overall been going slow. One of the reasons why I went back to just playing like non-crypto games, essentially, just because the industry is moving really slow, a lot slower than I thought, unfortunately. But we can at least attempt to get revenue distribution from gamers. So we got 3 payments so far, but after that third one, we haven't gotten anything. And then I have no Illuvium transactions this week. So that is our weekly numbers. So now, as always, we go into our charts, and we start with our favorite, gold. This gold's been the best this whole time. Nothing has a better looking chart than gold. Could technically put the line back here because this is a lower high, but this is a much cleaner trend right here. So going back to October 2023, same thing, boom, 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 all the way up, just clean in this trend. And gold did hit $3,000 this week, or this past week. It was very brief, but it did happen. So now we're going to see if it can maintain it, move past it. People in the market are very suspicious of big round numbers. It's kind of a funny phenomenon, but it has nothing to do with the actual market activity. It's just a big round number. It's a psychological thing. But we did hit it nonetheless. And as you can see, we had this big kind of sell-off in gold come back back in December. And it's come up ever since. Had a bit of a sell-off, and it's already coming back up, reclaiming that all-time high. So gold, 30% of the portfolio. 30% of the portfolio. Remember, I I equally distribute 100% of the value of the portfolio across all 6 of these assets, but I don't put any greater than 30% in any one asset because I want to be diversified. A smart decision would be just be 100% gold pretty much this entire time in this portfolio, and I would have made money, would have done great. But that's not diversification. At some point, gold will turn, as it always does. It's just a matter of time. Like if you look at just this ETF going from September 2011 to September 2011 to December 2015. This was like a down pattern right here. Oops, that's the wrong one. I forget. Where's the arrows? Arrow. There we go. So as an example. So gold in this time period went down. So I wouldn't be having 30% of my gold or 30% of my position in gold during this time period because of how much it went down. I would have it in something else. But right now you see this giant uptick here. This is where we're invested 30% in our gold position. So the maximum position is going to be 30%, and ideally I'm going to be putting in what I think is the best performing asset, which clearly has been gold. So just to show you an example, there's ups and downs. No, nothing lasts 30% in your portfolio or my portfolio forever. It's going to eventually get moved around. So that is gold. Then we have commodities, which over a 5-year period has done great. Also like gold, just performing very well right now. You see in this trend going back to July of 2022. It's been a really good trend. It broke out here, had a sharp spike up and drop back, but then look at that, it's already starting to go back up again. Like I'm still waiting for it to return to this trend, but it has not. Waiting for it to break, but maybe this is the end of it because it was such a big run up that it might start like chopping around and then come down. We'll see. But I definitely look at the inverse of bond yields and commodities or inflation to try to see when there's going to be a flip. But I still have 20% of my allocation into commodities, so still doing good. If it breaks this trend though, starts coming down and it breaks this trend, then I'm gonna have to reduce the position. But to me, that would mean inflation's going away, and I do see some inflation metrics coming down, but I don't know if it's gonna necessarily go away. I don't know if this is temporary or this is like the new regime we're in, where we have either disinflation or deflation. Disinflation is just de-inflating what's already happened, and deflation is just going down before what it normally was. So I don't know where we'll be at, but either way, it looks like we still have inflation. And then bonds. So as I said, I increased my position by 15%. To 15%. I apologize. So if we look at a 5-year, bonds have been coming down for 5 years. So that's why I've hate bonds so much, because they've been doing so bad. But there was kind of this bottoming in October of 2023. Around the same time, gold started performing really well. And so far, since this hasn't gone below this lower high, depending on how you look at it on the chart. So hopefully we kind of bounce maybe in this trend. But at some point, I'm hoping that we get a little momentum in bonds. Obviously, the inverse of being long stocks. So if I look, or commodities. So if I look at let's see if I can add one on here. 10 year. Oh, US 10. That would be smart. There we go. Actually no. Go back. Not price go. Not new pane. Okay, yeah. I just gotta take it back. So kind of look at commodities as. Which one did I pick? Is that right? US 10Y. My bad. Let me try that again. US 10Y. No R. There we go. Okay. So kind of look at it. Look in the trend, the 10-year, and then the commodities index being a little correlated. At some points, not correlated. But a lot of the let's see, US inflation. Looking at just kind of the trend, how they correlate and decorrelate. I'm thinking in my mind, like you see this divergence right here. I'm thinking at some point the US 10-year is going to come down, which means commodities are going to be coming down, and that's when bonds are going to rise. So if I look at my ETF, you see a lot of inversion, right? See, look at this inversion. Let me make it a line, make it easier for everybody. There we go. So the blue line, look at this. Look at this inversion. It's disgusting. Okay. Do it on a 5-year. I'm going to remove this arrow because it's kind of distracting right now. So the blue line is my bond ETF, and this reddish line is the 10-year yield. And you see how they are polar opposites, right? When the blue line's coming down, which is the 10-year yield, the red line's going up. Right, the bonds, right? The polar opposites, right? So if I throw in the, let's see, what's the name of it? I'm always going to forget the name. There you go, TRGF. Throw in the TRGF. There you go, price scale. So you see the purple line and the red line, the 10-year yield, are pretty correlated, right? So as long as commodities are going up and the 10-year yield's going up, that means, inflation's going up and bond rates are going up. But when they come down, that means the bond index will come down. So that's why I'm more into commodities right now, because they've been going up. But when it flips, hopefully, if yields are coming down with commodities, if they're coming down with inflation, that means my bond position in this blue here will be going up. But as of right now, you just see this inverse. So this blue line is inverse of the red and purple. So blue line coming down, my bonds, red and purple, inflation and rates going up. Then my bond position going up, my blue line over here going up, so bonds going up, and then inflation and rates, or commodities and rates, going down. And then inverse, 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 right? So if rates go down, that would likely mean inflation's going down and the price of commodities is going down. So with my current position in USCI, I would probably reduce that, maybe from 20% to 15%, just kind of see what happens. And I may take that 5% and increase it to bonds, because if inflation is going down, commodities are going to be going down, as well as the yield, 10-year yield is going to be going down. So I'm going to want to increase my bond position. But like I said, I don't think inflation is going away, at least not yet, which means interest rates are going to remain higher, which means holding bonds is not going to be as good a position, because the value of the bond's going down. The interest rate's on it's higher, so your payments, whether they're monthly, quarterly, or whatever you're getting on your bond, the payments are higher, but the value of your bond's going down. Since I primarily use these as ETF investments, I invest in the bond as the ETF itself, so the price appreciation, not so much the yield on that bond. It's nice to have that yield on that bond, because I do get a little bit of those payments. I get those dividend payments, but primarily I'm looking for bond price appreciation. So we'll see what happens. Like I said, as you can see, the purple and red inflate commodities and rates going up, so bonds going down. So I don't know when the turn will happen. It will, I believe, inevitably happen. I don't know by how much, like a lot or a little, but these will start coming down, which means my bond position will start coming up. So I'm just kind of like trying to time that, but timing the market's always like possible, unless you're like super amazing tech, like investor or whatever. But that's kind of like what I'm looking for on the bonds and commodities, the difference between them, One's up, one's down, one's up, one's down. So if there's ever a turn and these flip, that means my bond position hopefully is going to be doing better. Now, UUP, US dollar. This has been a shit position. It's been going down a lot. If I look at the DXY, look at this drop. Look, there's a big drop going on 5-year. So it's really been going sideways, right? This was a good time to get into it in September 24 because of how much it went up. But now it's like giving it all back pretty much. It's all coming down. It's just drooping down. All right, so the dollar is getting hurt right now. And if you remember on our UUP position, this sell-off right here was from the dividend of the ETF, so there's a little bit of price manipulation in the ETF. But I reduced my dollar position from 20% to 15%. So I'm still 15% in dollar, 15% in bond, 15% in stocks right now. So that's my position. But the dollar's been coming down. So I don't know if this is a recoverable trend or not. I think it's pretty well broken. And I don't know if it's going to even go below this red trend line right here, from this peak to this peak and down. Right, but at the very least, it already looks like it's coming closer, and like tap it. We'll see what happens. But this trend has not been looking good. So that's why I decreased my dollar position. So we'll see what happens on that. Still at 15%, but it's been coming down so much, I had to make a change. And then stocks, look at this. Look at this, breaking the trend already. So not doing good. What's the S&P doing right now? Let's see. Also not good. Look at that. Look at these trend breaks right here happening. This is what I said, like the past month. This is like February 20th till today. Look at this. This is what I was talking about. This is why the portfolio is being so volatile and choppy right now. Breaking trend right now. This is the S&P 500, right? So we had this break back here in September of 23. Now here we are of March of 25, and we're just like, or I should say February and March of 25, just this huge drop, this huge sell-off. Now there's like a bit of a, I don't want to say a bottom because who knows, right? But it's like, it looks like it's going a little sideways right about here over the past couple of days. But you look at it on the long term, like this is just boom, this is a huge drop. And of course our equal weight, same exact thing, huge drop, right? So we had this drop from November of 24 to December of 24, big sell-off right here. And then from, like I said, February 20th to today, another big sell-off. So we're breaking out of this trend. I'm not 100% sure if I should reduce my stock position down from 15% to 10% because of all the selling. I think 50% at least is not a huge portion of the portfolio. That means 85% of my portfolio is in other things. But still, this is a pretty hard sell-off. So I don't know if most of this is from like tariff talk, where we want to tariff our neighbors, Canada and Mexico, for whatever reason. I don't understand the logic on that. We're very well economically aligned to the three countries, and we're on the same continent. So, there's a lot of like incentive to work with them, but clearly not, according to this administration. But I do fear that because tariffs are mainly going to affect a lot of these big companies, like especially in the S&P 500 that are multinational companies. Well, when you're tariffing your neighbors, where these big companies have businesses set up, like you're hurting their business, so it makes sense why the market's selling off. But there's been so much back and forth, like Trump will say he will or will not do tariffs. Like he'll say he'll do it and then he'll pull back, or he'll say he'll do it, then he'll pull back. It's just like this back and forth thing. So he's like intentionally scaring the market, I guess, to see what happens, which is fucking funny. But it's not too crazy from his first term. He had tariff talk back then too, and he was very pro-market his first term, I'll say that much. This term doesn't seem as much pro-market, but still looks at the market, obviously. Even if he says he doesn't, he still does. Because whenever like big sell-offs happen like this, he seems to pull back on these tariffs. But I don't know, maybe if the tariffs actually go in, that means the market will crash, because that's what seems like it's being insinuated. If these tariffs actually go in, like the market's been selling off. But I don't know. I don't think he will, maybe. Or he'll do minimal tariffs. I don't know. But it does seem like a lot of this tariff talk is like fucking with the market, unfortunately. So you see these big sell-offs in the market. Remember, we're only 15% in stocks, or in the stock market. So it's not detrimental to a portfolio, but it is causing volatility for sure. Then, of course, Bitcoin just still selling off. Remember, it got back into the 100K, got into the McDonald's pattern right here. The M pattern. I saw someone online say that was hilarious. If we look at Bitcoin right now, you see, keep showing this chart. Going back to 2017, there was our peak. We had two peaks in 21. Then we have this double peak at the end of 24, beginning of 25, and then this big sell-off, right? So this trend line so far has been consistent, hasn't broken. At this point, I don't think it's possible we're going to come back up to this line. Like it might take some time. I don't know if it's going to come down like this. You know what I mean? You might do like a little fake out where it comes down 50% here and then shoots back up within like 1 year, or it might take like a couple years or more to kind of get back momentum. But at the very least, right now, it came up to the 100,000, a little bit above it, and then just boom, came down. Again, big round numbers. Gold hitting 3,000, and like it's like getting a real choppy, pulling back. And then Bitcoin at 100,000, getting real choppy and pulling back. So this is just stupid market psychology. It's annoying. But at the very least, I don't see Bitcoin doing well. If the market's not doing well, Bitcoin's not going to be doing well. If the S&P 500 is going down, the Nasdaq's going down, the Dow Jones going down, Bitcoin and crypto's going down too. That's the trend. They follow each other quite well. So at the very least, like I said, I keep it at 5% because of how volatile this asset class is. So 95% of my portfolio is not in crypto or Bitcoin. It's just 5%, just a 5% position. If I put it 100%, over a year term, I would still get a decent return, because if you look 1 year back from here to here, it's still technically higher from where it is now. But I mean, you fucking eat this loss here, you have a brief run up, and then you eat the loss here. It's like, it's too volatile. I would much rather have that money in gold, just straight up and to the right. Like, look at the beautiful trend in gold, just up and to the right. This is how I want my money to be. Much more stable and consistent. But anyway, that is our weekly numbers for week 34. As always, thank you for watching, and I will see you on the next video.